three stocks, three tickers at a 52-week low. Gold, GOLD, Warner Brothers Media, WBD, and Microsoft, MSFT. Now, guys, as you watch this video, if you like what we're saying, if it makes sense to you, I ask one favor of you. Please subscribe to our channel. It's a great channel. If you watch 4 or 5 of our videos, I guarantee you'll walk away with a better understanding of money and investing. So let's go with gold. Now, guys, gold is very simply Barrick Gold Corporation. All right. Now, this is a miner of gold, world's largest gold producer. Now, here's the deal. I'm quite sure if we look at the chart of gold, it's probably going to match somewhat this chart right here. Why? Because these companies make more money as gold prices are higher and make less money as prices are lower. Correct, Mo?
Correct. Absolutely.
Now, when it comes to commodities, my personal preference, and this does not mean it's your preference, my personal preference is if I want to make a play on a commodity, I want to buy based on a long-term secular change in the asset. So if I think an asset is at a low price, I want to invest in the ETF. What does that mean? Instead of investing in just Barrick, I want to invest in all major gold miners. All right. So Mo, why don't you show what you see right there?
This is actually unbelievable. This is the gold chart for 5 years. Now let's click.
That's Barrick.
Yeah, this is Barrick, and now this is actual gold. I mean, I'm going to go back and forth very, very quickly. You can see.
Look familiar, guys?
Looks exactly. Even this is what I'm noticing right here. This little blip and this little blip. Same thing.
So, guys, this is the way it's looking. It's commodities. Anytime you look into commodity, I would wait until you want to make a bet on that commodity. And if you want to bet on Barrick, go right ahead. My personal preference is to pick like a GDX or GDXJ, which is an ETF on gold miners. To me, it's a safer play on the whole industry versus one specific company. I'm not saying you shouldn't do it, but that's my personal opinion. That's what I do.
Yeah.
So to look at this company and run it through our stock analyzer, I have no idea. But if you're betting on gold, if you think gold's going to do well over long periods of time, gold is a hedge on inflation.
And in my opinion, that's the investment you should make. This should be over a very long period of time.
Yes.
Or something like you're trading it and you want to do something very quickly.
Right. But it's not based on anything fundamental.
Exactly.
It's based on the charts, which Mo also does do. Yes. I mean, if you look at analyst estimates, I think this is all pure speculation on where gold prices are going to be. There's no bearing of understanding other than where's gold price is going to go. And I'm just going to be okay holding GDX or GDXJ long-term on this. Mo, any other comments?
No, let's go to the next one.
WBD. Mo, you want to take over this one?
Sure. WBD. Guys, this one is this was the spinoff from AT&T. I've been very consistent in saying this. This is, in my opinion, before I even do any digging on this thing, I need to see more quarters of data from this thing because it's too hard for me to go in and say there's too many moving parts right now. I want to see maybe three more quarters of financial data coming out so they can get their stroke before I start making any type of assumptions here. Paul, even like when I look at Stock Analyzer, when I get to it, it's going to be very hard for me to say, hey, where am I going with this thing?
Well, can I show you something scary?
Sure.
What's the market cap? 25 billion.
Okay.
What's the enterprise value?
Oh, boy.
So, guys, what this means is enterprise value factors in the debt. So if you're to buy the entire company with no debt, you have to pay 110 billion. To just buy the equity is 25 billion. That's a huge difference. That means this company has a ton of debt on it. As an example, let's pick something like Microsoft.
And I'm highlighting one of the 8 pillars right here.
So look at Microsoft. Market cap, 1.7 trillion. Enterprise value, 1.85. Not even 10% higher. Right. Now look at Mo. Look at that. One of our pillars is based on the 5-year free cash flow to long-term debt, and it's 28-1. We want it to be under 5.
Under 5, and it's 28 right now. The shares outstanding, I'm sure there's something weird going on in there with the
merger and all that crap.
So I wouldn't really pay attention to an increase of 530%. But you can just see all of this data is just so out of whack. I understand why people are coming at this. They're looking at this saying, hey, it's $10 a share right now. There has to be something here.
Maybe not.
Maybe, to me, it's maybe not. I don't know. That's really what it's the too hard category for me. This is absolutely the too hard category for me. Let's see what the analysts have to say.
Well, not only too hard. With all that debt of $75 billion, if rates go up 3%, which they already have, and they have to refinance, you're talking about 3% on $75 billion is $2.2 billion loss of their cash flow. And what's their average cash flow the last 5 years? 2.5. To me, too much risk.
Yeah, their total current liabilities are more than their total current assets right now. So it's just a lot of debt. But this was the problem with AT&T.
Yeah, we kept worrying about AT&T.
Insane amount of debt, and this is the way that AT&T kind of moved some debt off of their books, and
it's still bad.
Here you go, and it's still awful over there. So analyst estimates, let's see what they have. As far as earnings per share growth, I mean,
wow. Well, it's because they're not making money.
Exactly. And even when we come down to revenue growth, mid-single digits, but again, who knows if that's true?
I mean, with so much debt,
this is all assumptions.
Plus, the other thing is with so much debt, if when they have to refinance these things, it's like, I mean, 3% increase, you're going to chop off $2.1 billion in free cash flow off their $2.5 billion average. So unless they have amazing growth potential in that free cash flow, which they could, and debt's a great way to magnify your returns, but it's still, to me, there's better options out there, in my opinion.
All I have to say is I hope that their content over the next couple of years is
smoking.
Absolutely fantastic.
Yeah.
All right, let's go to a good company.
Microsoft. And I love the fact that Mo said that because he's going to say he said it's a good company. I think from an 8-pillar perspective, we talked about this. We love seeing this. Look at these 6 check marks. The only thing is this. The 5-year price to free cash flow and the 5-year PE are just a little high. Now, does that mean it's overpriced? I don't know. If they're going to grow 20% a year for the rest of the time, it's a pretty cheap company.
Yeah, it's really cheap right now.
But we got to decide using our stock analyzer tool if that's a reasonable price. So look at the analyst estimates. They're expecting mid to high double-teen profit per share increase. So in June of 2027, $20 in profit. If you multiply it by 15 average, talking about $300 stock price. Okay, not bad. But right now it's selling for 25 times.
And 25 times.
So let's look at the revenue. Revenue growth, looking pretty solid. Looking pretty solid here, okay? Low double digits, great company, low debt. You saw that low debt number on the enterprise value. They're not, one thing I like about this is they haven't bought back a ton of shares. Because when companies are overpriced, you don't want them buying back shares. That means they're investing your money in overpriced assets.
Yeah, and that's a really good thing that you have a company that is overpriced, however you want to say it, and they weren't aggressively buying back shares. We've seen a lot of companies that have bought back shares aggressively when we were looking at it saying, why would you be doing that?
I wish that was 0%.
Yeah.
I just wish it was 0%. Because to me, I'm looking at going, guys, give it to me in a dividend versus investing it back in yourself at a very high multiple. That doesn't make any sense in the world to me. And guys, I repeat, you got to subscribe to the channel because I'm quite sure that you're not hearing this on other channels out there. Don't just listen to the stupid hypesters out there who say, Microsoft's an awesome company, you got to buy a stock. No. When you're buying a stock, you're buying a piece of a business. And you have to separate the stock from the company. You have to look at them and you have to decide when the stock price is not reflecting the accurate price of the company to the downside, you want to be a buyer. And let's see if that's the case for Microsoft. So let's use our stock analyzer tool to figure that out. Mo, do you want me to give you the assumptions? Do you want to give me the assumptions?
You give me the assumptions.
I knew you were going to say that. All right. So we're doing a 10-year analysis here, folks, not just the 5-year that the analysts were doing. So I'm going to go with 5, 8, and 11.
Okay.
Next thing, profit margin. I'm going to go with 29, 31, and 33. And for free cash flow, I'm going to do the exact same thing because over long periods of time, free cash flow and profit should be pretty much the same thing, especially with companies with such low debt and all that stuff.
Okay, PE 10 years from now.
Okay, the current PE is 24. 10 years from now, the company's going to be a lot bigger, and I'm trying to determine a PE and a price to free cash flow for 10 years from now when I determine a value 10 years from now. It's a big company.
Huge company.
It's going to have a good moat.
Right.
I think 14. I'm going to go 15 and a half.
Okay.
And I'm going to go 17.
Okay. I think it's fair.
Because I do think that, same thing with price to free cash flow.
Okay. 14 could be low.
I think 14 could be high. I think 13, 15, 17 is probably the best one to do.
Really?
Yeah. Listen.
Explain.
I think things have been very euphoric lately. No, you know what? 14, 15, I'm very comfortable with that. But that's the point, guys. The point of value investing is we all have the same ideas, but it's just different ways of approaching it. Now, for desired return, you can get 9 or 10% from an ETF, and the higher assumptions you make, the more margin of safety you need. So you need a higher return for that higher margin of safety. Think about that. The less you pay for an investment, the higher your return. So if you want a high return, you got to decrease the investment amount you make.
Right.
So I'm going to go here, 12.
Okay.
13.5 and 15.
I think it's fair. All right.
Analyze button.
227.20 is the current price. Let's see what this spits out. $114 on the low end to $181 on the high end. Middle ground, 144.
Yeah. So I look there and say, listen, we've done videos in the past where it was like 170 was the high end, 160, 200. The point is it's lower than today. So we just got to be a little more patient. But guys, that's the key to it. Be patient, subscribe to our channel, watch our thousands of other videos that we have. We make 20 or 30 a week. Keep doing it. Subscribe. You will walk away as a smarter investor. Thank you very much for your time.